Welcome back to the channel. I have done a few videos breaking down covered call and cash secure put, but I realized I never actually answered the basic question. What is the real strategy? Like seriously, why should you even watch those other videos if you don't understand what is the real strategy is in the first place? So in this video, we are gonna fix that. I'm going to walk you through exactly what the real strategy is and why it is so high up and why me and so many others use it to generate consistent income. Okay, let's break this down simply. The whale strategy is a popular option trading methods that use collateral to repeat selling two types of options, cash secure put and covered call. The goal to collect premium income over and over again. Before we dive in, let's define a few key terms so everything makes sense. Collateral. When I say collateral, I just mean what you are putting up to secure the trade. That could be 100 shares of a stock you already own or enough cash to buy those 100 shares if needed. Think of it like a deposit. It's like what makes the option trade possible. Cash secure put, CSP. A cash secure put, or CSP for short, is when you use cash as collateral to sell a put option. Basically, you are saying, hey, I'm willing to buy this stock at a lower price, and I'll get cash ready if it happens. In return, you get paid a premium upfront. Covered call. A covered call is when you already own 100 shares of a stock and you use those shares as collateral to sell a call option. You are basically saying if the stock goes above a certain price, I'm okay selling it. In the meantime, you get paid a premium for offering that chance. Premium. When you sell an option, you get paid something called a premium. That's basically instant income. Money you earn upfront just for agreeing to take on the trade. Think of it like a rental fee. Someone pays you for the opportunity. There are two phases of the real strategy. Number one, selling a cash secure put. You pick a stock you want to own. Let's say stock A. Currently is trading at $100 and you are willing to buy it at $95. So you sell a CSP with a $95 strike price. That means if stock A drop below $95, you will be forced to buy 100 shares at that price. But either way, you collect the premium upfront, say $50 for making that trade. Number two, selling a covered call. Now you own the 100 shares. Great. You move to step number two. You sell a covered call at a strike price where you'll be happy to sell the stock, say $100. If it hits $100, your share gets sold. If it doesn't, you just pocket another premium and repeat. The premium goes straight into your buying power when the trade is fulfilled. It's not always reflected in your portfolio value right away, so don't panic if your account value doesn't jump instantly. And yes, you get that premium immediately, even if the option expires 2 weeks later. In a put, you want the price to stay above the strike, so you keep your cash and premium. In a call, you want the price to stay below your strike, so you keep your shares and the premium. Either way, you are aiming to collect premiums without getting assigned. But always assume you will get assigned. That is how you protect yourself. Also, don't run the whale on stocks you are emotionally attached to. Be ready to sell or buy. Understand the risk. Alright, here is what an option chain looks like on Tiger Broker using Google as an example. Let's say the current price is around 162. Now imagine you want to sell a cash secure put with a 157.5 strike price. That means you will need 15,750 in cash as collateral. In return, you might get a 94 premium. That's $94 straight into your account just for placing the trade. Now let's flip it. Suppose you already own the stocks. You could sell a covered call at that same 157.5 strike price Again, you collect a premium upfront, and if the stock hit 157.5, you sell the shares at that price, take your profit, and restart the whale strategy all over again. So what happens if the stock price suddenly goes up? Well, good news. It's a win either way. If you are selling a cash secure put, an increase in stock price actually works in your favor. Since this is a neutral to bullish strategy, you get to keep all the premiums you collected. And as long as the stock stays above your strike price, the put expire worthless, you keep the cash and move on. Now, if you are running a covered call, a price increase is also a good news. For example, say you bought 100 shares of Google at 157.5 and now the stock jumped to 165. You sell a covered call at a 170 strike for 1 week, and let's say the premium is $100. If the stocks go above 170, you are obligated to sell. But here's the upside. You keep the $100 premium plus the capital gain from 157.5 to 170. That is a $12.50 gain per share, or 1,250 total. Add that to the premium and your total profit will be 1,350. Just keep it in mind. Your profit is kept using this strategy, but hey, a win is a win. So what happens if the stock price suddenly drops? Let's say with the cash secure put, if the stock fall below your strike price, you will likely be assigned 100 shares, and your 15,750 collateral will be used to buy them at 157.5 per share. But that is not necessarily bad. You are willing to own the stock anyway. And don't forget the premium. If you collect 0.94 per share, your real cost base is actually 156.56 instead. That is like getting the stock at a discount. And if you are not ready to be assigned, you can always roll the position to a later expiration date. Now, if you are doing a covered call and the stock drop, you still keep the premium, but your share lose value. If the price keep dropping, you could sell another covered call with a longer expiration date to collect more premium over time. But here's a warning. If you sell a covered call with a strike price below your cost basis and the stock get caught away, you'll be locked in for a real loss. For example, say you bought 157.5 per share, but you panic and sell a covered call at 155. If the stock get caught, there is a $2.50 loss per share, or 250 total. So my advice, never sell covered call below your cost price. Protect your capital. So that is the real strategy in a nutshell. It's all about using what you already have, either cash or stock, to generate regular income through option. I got a full playlist that goes deep into option trading. So check that out right now. If you find this helpful, give the video a thumbs up for the YouTube algorithm and share it with anyone learning to trade options. Now, if you are starting to see how this all connects, how selling covered call and cash secured puts can be used to consistently collect premium, you are already on the path to mastering the real strategy. And hey, if this video helped clear things up for you, don't forget to hit that subscribe button. I got a full playlist diving deep into covered call, cash secure put, and real life example. So you can see exactly how I run the real strategy. Also, if you know anyone just starting out with option trading, maybe a friend or a coworker who is curious about how to get into the market safely, share this video with them. It might be exactly the beginner-friendly explanation they need to get started the right way. Alright, I will link that full option playlist right here on the screen and in the description below. Thanks for watching, stay positive, work hard, always be kind, and I will see you in the next one. Until next time, trade smart and stay profitable.